This is Trade Alive with IUX, where markets come alive and trading gets real. Let's go live.
This podcast is brought to you by IUX Trading Platform, elevating your trading experience.
Hello and welcome to the IUX Podcast from the IUX Education Team, powered by IUX Trading Platform, where we analyze the intersection of market mechanics and trader psychology. Do you remember where you were during the Brexit vote? Do you remember watching the results come in, seeing the British pound in free fall, dropping percentage points in a way that just didn't seem real? Or that first terrifying market crash of the 2020 COVID pandemic, that moment when the world shut down and the stock market seemed to fall off a cliff day after day with no bottom in sight? Or about that shocking central bank announcement, a moment when a governor was supposed to say one thing and said the exact opposite, causing the market to move hundreds of pips in a single second. These are the memorable news events. They are moments of pure, unfiltered chaos. These are the moments where you look at a chart and your brain can't even process what it's seeing. The chart is moving hundreds, sometimes thousands of pips in minutes, not hours or days. A year's worth of price action can be compressed into a single afternoon. But for a select few, for the professionals who understand risk, these exact same moments represent a career-defining opportunity. They see beyond the chaos and see a fundamental repricing of the world. And that brings us right to our topic today, trading on the most memorable news. Is it a smart, calculated move, or is it just a high-stakes bet? This isn't like trading regular scheduled data. This is a different beast entirely. We're not talking about a simple jobs report that misses by a few thousand. We're talking about the Black Swan events, the true shockers, the moments that are completely unpredictable, come from outside the normal realm of expectations, and have massive, world-altering consequences. These are the moments that rewrite the market map for the next decade. The challenges and what we're here to explore is finding a viable strategy for trading this kind of news. More importantly, it's about finding a strategy that balances that immense profit potential, the kind that can make a career, with the very real catastrophic risk that can end one in an instant. Today we're going to examine both sides of this high-stakes coin. Understanding the two types of news. So to get started, we need to be clear. When we say news trading, we're really talking about two very different things. Think of it like two different weather events. One is a predictable daily forecast, and the other is a sudden, unforecasted hurricane. You have your scheduled news. This is the bread and butter of the economic calendar. It's the known unknown. This is a specific strategy that involves opening and closing positions based on major planned economic or financial announcements. We know the NFP report is coming on the first Friday of the month. We know the Federal Reserve will announce its interest rate decision at 2 p.m. So instead of relying purely on technical chart patterns all day, these news traders are laser-focused on the clock. They're waiting for those specific, scheduled events, like that central bank interest rate decision, a new inflation report, the CPI, or, of course, the big one, the employment figures, like the NFP in the U.S. The core idea here is to capitalize on the market volatility. The price before the release is based on expectations. The volatility after the release is the market's instant, real-time adjustment to the new economic reality. It's a rapid repricing. But then you have the second type, the memorable news we talked about, the black swans, the surprise announcements, the election results that go the wrong way, a sudden declaration of war, a bank failure over a weekend. These are unscheduled, and that is the single most important word. There is no forecast on the calendar for this. There is no expectation baked into the price. The news hits the wire, and it is a pure shock to the system. The chaos that follows isn't just volatility. It's a breakdown of normal market functions. Liquidity evaporates, spreads widen to insane levels. It's not just a simple repricing, it's a panic. It's a fundamental questioning of everything. The strategies we're about to discuss can apply to both, but they are especially critical for surviving the big, memorable, market-shaking events. With scheduled news, a bad trade might be a quick, controlled loss. With a Black Swan event, a bad trade can be an account-ending event. The risk is not just different in degree, it's different in kind. And to face that risk, you need to understand the language of the market itself. The key terms you must know. If you don't, you're not making calculated decisions, you're just guessing. Think of an economic release like a big, important test for the economy. There are 3 data points you must understand. The previous number, this is the last test score. Let's say last month the economy added 150,000 jobs. This is important for context, but it's history. It's in the past, and the market has already priced in this old news. The forecast, or consensus, this is the single most important number before the news is released. This is the grade that all the smart kids in the class, all the big banks, economists, and analysts predict the economy will get on this test. Let's say the forecast for this month is 180,000 jobs. This forecast creates the expectation. The entire market is holding its breath, and the current price of a currency or stock is already based on this 180,000 number being correct. The actual number. This is the moment of truth. The timer hits 0, the data is released, and the actual grade is revealed. Now, here is the secret. The market's reaction is almost never about the previous number. It is driven entirely by the deviation, what I call the surprise factor. It's the gap between the forecast, what everyone expected, and the actual, what we got. Let's run 2 quick examples. Scenario A, big surprise. The forecast was 180,000 jobs. The actual number comes out at 250,000 jobs. This is a massive positive surprise. The market expected a B-, and it got an A+. Because the old price was based on the B- expectation, the market must instantly and violently reprice itself to this new, much stronger reality. This is what creates that massive, explosive move. Scenario B, no surprise. The forecast was 180,000 jobs. The actual number comes out at 181,000. This is exactly what was expected. It's a B-. What happens to the price? Often, nothing. It just sits there. This is why you'll sometimes see big news released and the chart doesn't even flinch. It's not because the news wasn't important. It's because there was no surprise. The expectation was met. A big surprise, a high deviation, is the fuel that lights the fire. The lure. Why these events are so seductive. So let's ask the big question. Why do traders even bother? If it's so chaotic, so risky, and so wildly unpredictable, why not just sit it out? Why not just close your platform and go for a walk and come back when the dust is settled? The answer, as you might expect, is a powerful one. The appeal of trading memorable news is obvious, and it can be summed up in one powerful, intoxicating word: volatility. We're not just talking about normal, choppy, back-and-forth movement. We're talking about explosive, directional, tsunami-like price movements that you simply do not see in normal market conditions. It's the market's raw power fully unleashed. The most seductive part of this is something we call time compression. Think about it. A normal swing trader who holds trades for days or even weeks is like a marathon runner. They must patiently wait for their analysis to play out. They're disciplined. They might hope to capture a 500 pip move over the course of an entire month. That is a marathon of patience, endurance, and emotional control. A news trader, on the other hand, is a 100-meter dash sprinter. They're looking at the exact same 500-pip move and seeing the potential to capture it in 15 minutes. This is the lure. In our modern world that craves instant results, the marathon of swing trading can feel slow, boring, and inefficient. The 100-meter dash of news trading feels electric. This speed, this potential for instant gratification is the core of the psychological trap. It's a massive dopamine rush. There's no waiting for your thesis to be proven right over the next 3 weeks. You find out if you're right or wrong right now, in the next 30 seconds. And this leads directly to the fantasy, the potential for extraordinary profits in an incredibly short amount of time. We're not talking about a good day's work. We're talking about the kind of profit that can make your entire month or even your entire year in a single afternoon. If you guess the direction right, like shorting the British pound right after the Brexit vote was confirmed and watching your P&L tick up faster than your eyes can even read the numbers, or buying the US dollar after that huge NFP surprise we talked about, the gains can be absolutely enormous. This is the siren song of the market. It's that beautiful, irresistible call that has lured traders for decades. It's the idea of catching that one perfect, explosive, historic move. It's not just about the money, is it? It's about the story. It's about being able to say, I was there when the market broke. It's about feeling like you have tamed the chaos, like you saw the opportunity when everyone else saw only panic. More than anything, it makes you feel like you are at the absolute center of the financial world. You're watching the news anchors on TV breathlessly describing the very event that you are actively trading. You're not a small fish in a giant ocean anymore. For that one moment, you are in the event. You are part of history. That feeling, that combination of adrenaline, profit, and ego is why, despite all the risks, trainers will always be drawn to the fire of the news. So if that first minute is just pure, unpredictable chaos, how do experienced professional traders actually handle it? The professional strategy, trading the aftermath. Well, in most cases, they step aside. They take their hands off the mouse. They don't try to trade that first 60-second candle. They know that an initial, unpredictable spike is not a high-probability setup. It's an environment of pure chaos. It's algorithms fighting other algorithms. In these first few seconds, liquidity, the number of buyers and sellers available, dries up. This means two very dangerous things happen. Spreads widen, the difference between the buy side and sell side can become massive, meaning you are in a big loss the second you open a trade, and slippage. The price you click at is not the price you get. The market moves so fast that your order gets filled at a much, much worse price. So the professional doesn't try to predict the spike. Instead, they use a reaction strategy. This entire approach is built on patience. It's about letting the market and all the emotional traders show their hand first. You wait for the market to reveal its true intentions. This professional approach generally splits into two distinct strategies. Strategy 1, trading the new confirmed trend, the second wave. This is the most common and, frankly, often the more reliable approach. Think of the news release as a giant tsunami. That first spike is the initial wave hitting the beach. It's chaotic, destructive, and unpredictable. You do not try to surf it. Instead, this strategy involves letting that initial spike happen. You watch it, but you don't touch it. You also let the first wild pullback or fake out, that first knee-jerk correction, run its course. This is the water pulling back out to sea. You're not trying to catch the first explosive move. You're waiting for the dust to settle. You're allowing all the panicked, emotional traders to get flushed out. Once the price action calms down and confirms this new post-news trend, for example, by forming a new clear level of support or resistance after the spike, then you look to enter. This way, you're not caught in the initial explosion. You're strategically capturing the more predictable, confirmed second wave of the move. You are joining the new, stable direction that the news has created. Strategy 2. Trading the correction, the fade. Now, this second approach is a bit more advanced and is generally considered higher risk. This is a contrarian strategy, meaning you're trading against the initial move. Here's how it works. You watch that initial massive spike. Let's say the euro just shot up 150 pips in 1 minute on a news release. You, the contrarian trader, make a professional judgment. That move was a complete and total overreaction. You're operating on the assumption that that first wave of panic and algorithms pushed the price way too far, way too fast. It's like a rubber band that's been stretched to its absolute limit. You believe the news itself doesn't actually justify such an extreme price level. You then fade that move. You place a trade in the opposite direction. You'd be shorting the euro in this case, betting on that overstretched rubber band snapping back to a more logical, reasonable price level before the real, more sustainable trend eventually begins. This is a short-term trade. You're not trying to fight the new long-term trend. You are simply aiming to profit from the immediate, exaggerated pullback as the price reverts to the mean before the real, more sustainable trend eventually begins. So let's circle back to our original question. Is trading on memorable news an opportunity or a trap? The truth is, it's both. It's an environment of extremes. It's a high-risk, high-reward environment that amplifies everything, both your potential profits and your potential losses. The mistake most traders make is treating these Black Swan events like a coin flip. They try to guess the number before it comes out, or they try to trade that first chaotic 1-minute explosion. They get burned by severe whipsaws, where the price flies up and down, and extreme slippage, where their trade gets filled at a terrible price. A true professional strategy for trading on memorable news is a reaction strategy. It's not about predicting the explosion, it's about patiently trading the consequences of that explosion. It's about letting the initial panic subside and then stepping in with a clear, calm plan to trade the new reality. Whether that means you're a contrarian fading the move to catch a short-term correction, or you're a trend follower trading the new trend to ride the long-term paradigm shift, both are valid, calculated strategies. Remember, the goal is not to hit one home run and retire. The goal is to apply a professional, repeatable process that manages extreme risk while capitalizing on clear, confirmed opportunities. That is what defines a sustainable trading career. If this episode gave you valuable insight, you can click like, subscribe, follow, and share it with another trader who might need this reminder. In the next episode, we'll dive even deeper and explore more. Thank you for listening. See you in the next episode. Have a nice day.
You've been listening to Trade Alive with IUX. Ready to put these insights into action? IUX is here to power your next winning trade.